For Wall Street Media, this is Isabella. I'm here with Doug, and we'll help you make money in the stock market with information you can't find anywhere else.
Some stars you can't find. Oh, you can be found other places, can't you?
Speaking ironically?
Yes, I was.
Not a star?
Our little star
No.
on the cover of the Village Voice today. And Rich Gordon is our other star from Wachovia. Everyone loves him, and he's talking about inflation.
Oh.
Guys, this is the guy that Wall Street listens to. You need to take a listen here.
Okay. Rich Gordon, fixed income market strategist for Wachovia Securities (WB), describes the uptick in inflation spurred on by commodity prices and whether or not the U.S. really has a strong dollar policy.
Cool. Look, Jeremy.
The inflation report released on Friday continued to show an uptick in nominal CPI due to rising energy and fuel prices. Nominal CPI rose to 4.2% from 3.9% in April. The surge in oil and food prices has caused inflation expectations to rise over the past several months, and it's increased concerns that the Fed might have to start raising rates to fight inflation. The increases in energy and food are all finally starting to impact inflation. Record-breaking energy prices are also affecting corporate behavior, especially airlines. They've responded to the doubling in fuel costs since last year by charging fees for checked bags and soft drinks, raising fares, grounding planes, and cutting jobs. With fewer seats available, prices much higher, and the weather unstable across much of the U.S. so far this summer, more people are electing to stay close to home rather than take long-haul vacations. The price of oil continues to reach new historical highs near 140, and volatility remains very high. This sharp rise in prices has forced the Saudi Arabian oil minister to initiate a meeting to discuss why prices at $140 are fundamentally unjustified. Current oil prices threaten to curtail the global economic expansion, and in the long run could be detrimental to oil producers as the incentives to develop alternative energy sources are greater than ever. Through a combination of fundamental growth in key emerging markets like China and India, coupled with poorly designed and executed domestic fiscal and monetary policies, the U.S. now faces similar stagflationary pressures to those seen in the 1970s. These pressures have resulted in increased jawboning from U.S. officials, most notably Fed President Ben Bernanke, that the U.S. favors a stronger dollar. The dollar is several percent higher since his comments were made, but has anything fundamentally changed that would indicate the dollar's long-term descent has stopped and begun reversing? Here are some points to consider. First, the Fed kept the real funds rate negative for 3 years in a row between 2002 and 2004. When it finally began tightening, it did it in a slow, steady, and transparent manner that rewarded rather than punished aggressive financial risk-taking activities. This period coincided with an increased commitment to an overseas war, rising energy and commodity prices, and a massive buildup in foreign central bank reserves. U.S. fiscal and monetary policy during this period contributed to a general increase in inflationary pressures worldwide and helped set the table for the current situation. Second, the dollar's lost almost 20% since the beginning of 2006. We believe that the decline is fundamental. The U.S. is a lot weaker financially than it's been in many years. The chart shows the amount of cash that the Fed has added to the financial system through repo, more than $200 billion since September 2007. Those additional repo and term lending arrangements have decreased the size of the Fed's balance sheet by over 30%, back to the same size it was at the beginning of 2002. The problem is that the U.S. economy is almost 30% larger than it was in 2002, so we have a lot less of a financial cushion now. If another major financial institution in the U.S. fails, a further impairment of the Fed's balance sheet could cause a sharp further decline in the dollar and lead to the divestment of dollar-denominated assets by foreign investors. Third, has anything fundamentally changed in the financial position of the U.S. versus its trading partners? Not really. Reported losses from Wall Street firms and large commercial banks have continued to mount, and additional announcements of capital raises have caused further damage to financial stocks. One way of viewing the relative damage that the U.S. financial system has inflicted on itself is to look at the relative performance of the U.S. financial sector versus the world's largest and probably most currency diversified bank, HSBC. The chart shows that the U.S. financial sector has underperformed HSBC by nearly 25% over the course of the last year. The dollar is a little over 10% lower since the beginning of June 2007, so we would attribute the rest of the underperformance to the massive amount of damage done to the balance sheets of U.S. financials from the subprime meltdown and its aftermath. Finally, is the U.S. really in a position to defend its currency given the current economic environment? Interest rate futures now show that the probabilities of a Fed tightening have increased. The 2-year yield is over 60 basis points higher over the past 6 trading days, and it's more than 160 basis points higher than on March 17th, just ahead of the Bear Stearns collapse. The question remains as to whether or not the benefits to the dollar from a series of rate hikes this year outweigh the potential further damage to the overall economy, especially the financial sector. With the extent of the damage to the U.S. banking industry so severe, it seems counterintuitive that the Fed would raise rates soon, even though at some point they need to stop responding to each and every economic downturn with a punch bowl of low or even negative real interest rates over an extended period of time. It seems more likely that corrections to flawed policies will need to be implemented very gradually and probably not in 2008. So we think that the 2-year Treasury is sold off too far, too fast. Does anybody really believe that the U.S. has a strong dollar policy? We'll believe it when we see concrete measures to restore our fiscal stability rather than well-meaning but most likely empty rhetoric.
No, you stop that. Okay, we're back on.
You should just, if you only knew what happened when the webcam was going.
You went through the night tonight for 6.5 minutes.
Oh, lucky girl. So anyway, Jordan Nick is getting a little frustrated apparently with my digression, so let me help you focus.
You love Wachovia, you said?
Oh yeah, I love Wachovia. They're my bank. They're so nice. Their whole thing with customer service is true.
Yeah,
really
probably a lot of people are nice to you. Rich Gordon, guys, Superman on Wall Street. Everybody listens to him when they're not tuning in for Isabella. Okay. Thank you very much. Come back. See, we've got tons and tons today, guys. And Covestor opened up to the public, so you can go there even if you don't show your portfolio and see other people's brilliant picks and their track record, alpha, beta, sharp ratios, the whole thing. We had Ricky Tata on earlier today. Come back to Wall Street Media and take a look and watch the interview with Ricky.
We're here every day at Wall Street Media. You can find us directly at wsmco.com.
Merci.
Thanks.